Good morning, everyone. My name is Gareth Bern. I'm CIO of Fixed Income at M&G Investments. And with me in the Cape Town office this morning, I have Eva Sanwai. Eva, great to have you with us.
Thank you.
It's fantastic to have our global colleagues in the office with us on the ground in South Africa. Eva, you've been seeing clients recently and you've been presenting at some conferences, so many people are probably familiar with yourself. But for those that aren't, perhaps you can just give us an introduction to yourself and your team and the role that you play within the global fixed income team.
Yeah, of course. So thank you for having me. I am a fund manager within our London office. I am the lead manager of our global government bond fund, so looking mostly at global rates and FX. And I'm also the co-manager of our global macro bond fund with Jim Levis. And those funds sit within our range on the fixed income desk, running from strategies from investment grade to high yield to emerging market to the more strategic flexible portfolios. So ours sits within those flexible strategic portfolios that have a wide remit in the fixed income universe.
Sure, that's covering a lot of the global market. I guess the question might be, so what sets your team apart and how do you manage to cover all of those different aspects of the market?
I think what's crucial with a global mandate and a global capability is having that global reach across the business. We have a brilliant team out in Singapore as well as out in Chicago, which not only helps with having fund managers, strategists, analysts on the ground, but also dealing capabilities, sales capabilities. It enables us to access those markets in real time, speak to people on the ground, speaking to issuers constantly, and really helps with us with that global reach. We also, in London and in Europe, have a brilliant credit research team, ABS research, financials research, as well as our own dealing capabilities in London, and obviously the wide remit of teams that we have in London to support the fund management capabilities. So there's lots of people, it's a big machine, but works very well.
Now, I think certainly from our side in South Africa, we can certainly reflect on the benefit we have of being able to leverage in that global team that you speak to. And I think there's a key competitive advantage that we've got, and really great that we can have people such as yourself join us in the country and be able to access those skills across the globe. So yeah, really fantastic organization I think we've got from that perspective. So you've been on the road and you've been talking to clients, and as I mentioned the presentation, your title of your presentation was Navigating the Global Fixed Income Landscape. For clients sitting out there, they look across the landscape and they kind of see all these risks. And you've got upcoming elections, you've got geopolitical risks, central banks, everyone's wondering, what's the next Fed move, or perhaps more importantly, what is the timing of the next Fed move? How are you and the team broadly approaching those questions?
I think in a global fund, we like to operate from a top-down perspective, which I think is important when you have that global reach. I think within a fund like that, it's important to have a few uncorrelated trades so that you're not completely driven by one global factor or external influence and that sort of thing. I think at the moment what's difficult is because so much, whether it be global valuations, whether it be other central bank moves, are relying on the US and relying on the Fed. It feels like we are entering a new phase where previously we had a phase of monetary policy convergence with everyone doing very similar things. We were all hiking rates to fight inflation, etc. Now we're entering a phase of divergence where there's different economic backdrops, different inflationary persistence, and we need central banks to start cutting rates and start bringing policy to a slightly more easy stance. But the issue is nobody wants to go first, nobody wants to front load the Fed. And so a lot is relying on what the US does. Having said that, there are anomalies. If you look at Japan, if you look at China, for example, and there's also lots of opportunities idiosyncratically within emerging markets, within investment grade. So it's important to have that overarching thesis and to have that overarching view of central bank regimes and what it means as a whole. But also within that, there are so many pockets of opportunities, both regionally, intra-region and intra-asset class. And so it's combining that top-down and that bottom-up to navigate those global themes.
And so just taking that kind of to the next step then is, so how are you actually positioned, kind of given all that you've said? You talked about some opportunities that are out there. Perhaps you can touch on how you're positioned in the global funds to take advantage of those.
Absolutely. So the way I look at the core funds is that we have 4 key pillars, is how I would look at it in terms of our developed market rates exposure, our emerging market rates exposure, our corporate credit, and our FX. That's to be very broad. I think within a fund like this, the key pillars, to keep it very simple, would be developed market rates and our duration inflation exposure, for example, our emerging market rates exposure, our credit exposure, and our FX, because we can use that as a separate lever as well to both add or reduce risk. I think the key themes at the moment within the portfolios are we are slightly long duration. If you look at valuations and you look at the starting point, the entry point now for duration, it feels like a much better entry point. If you were looking in January, for example, where markets were pricing in 7 cuts from the Fed, and then we had a surprise to the opposite of that, that was a poor entry point into fixed income given the valuations and what subsequently happened. If you look now, we're now at a point when markets are actually more hawkish than the Fed, so are pricing in perhaps a maximum of 40-50 basis points this year, and some people are even talking about another hike from the Fed, and the Fed have come out and said, we're likely not going to hike. So it feels like markets are actually more hawkish than the Fed, and that provides, in our view, a much better entry point into duration here. As I mentioned before, there are anomalies, so we are underweight Japan in terms of JGBs and Japanese duration, for example, so that's one of our key calls in that duration space. Otherwise, we like a bit of emerging market local, again, have to be selective, but broadly emerging market local bonds we like, less keen on hard currency given spreads. Spreads are tight across both emerging markets and developed markets, so we've been de-risking from a spread basis in favour of those high government bond yields. And on currencies, mixed positioning again, we don't see the opportunity in Japanese rates, but we like the currency, and we see opportunities in other higher yielding, sort of higher carry emerging market currencies as well.
And you talked about the credit aspect, so just taking on that perspective, so to understand you're underweight the credit markets per se, and as you say, favouring the government bonds, and effectively is that because you just feel the spread compensation you're getting there just isn't rewarding you for the risks that you see out on the corporate landscape?
Yes, I think there's a real mixed picture with credit at the moment. It feels like markets are very much trading based on the all-in yield as opposed to the tight spreads that we're seeing. For us, we think that's quite a lot of complacency in markets. If you actually look at net interest margins, they are starting to be squeezed. They're being very propped up by the large corporates, but if you drill down into some of the smaller areas of the market, we are starting to see a bit of stress. We think, especially compared to government bonds, you're not particularly being compensated for that spread premium, especially in high yield. We do think there is some value in investment grade because we don't think we're entering a phase of higher defaults necessarily. So if you're happy to, clip that carry from credit and you believe that those sectors or those industries can weather a slowdown reasonably well, that's where our credit research team becomes super valuable in this situation. But when you can, identify those areas that should be reasonably stable, then we're happy to clip that carry and take that credit exposure because of the all-in yield. But relatively to government bonds, we don't think the spread is compensating you for any sort of slowdown or even stagnation here.
Right. You briefly touched on Japan.
Yep.
And Japan certainly, recently on the road, and you've been talking to clients and at the conference, as I mentioned earlier, seems to be very topical. Can you perhaps draw a bit down or draw a bit more deeper into Japan?
Yeah, of course. I mean, Japan is the anomaly at the moment. They're the only central bank likely to be hiking rates versus a potential globe of central banks cutting rates. I think, we've seen a lot of factors influencing the currency, for example. It's been, particularly weak. We think a lot of that has been driven by external factors, so the dollar especially being very strong, and the fact that Japan are big oil importers, and so with higher oil prices, higher geopolitical conflict, that has been detrimental, and therefore means that they then import more inflation as well with a cheap currency. We also think that domestically they are looking at a slightly different backdrop versus the rest of the world. We are seeing more sticky service sector inflation, we are seeing more sustained wage pressure, and so they are very behind the curve in terms of those inflationary pressures starting to come through, but they are there, and we have seen that they are starting to be persistent to the point that the central bank has now exited their decades-long regime of negative interest rate policy and yield curve control. So we've seen those be removed or, rewound. And so we're actually entering likely a new regime in Japan, and that means that in terms of the government bonds, we likely don't particularly want to hold them, although the curve is steep, so there are opportunities at the long end. But broadly, we think that we're looking at higher yields in Japan, potentially not very high yields in Japan, but higher. And we think that if we do have the Fed start to cut, for example, and we have the Bank of Japan actually being more hawkish, those rate differentials should actually support the yen going forward, especially if we also have some sort of coordinated FX intervention, if we have a re-entry of the national banks, for example, into Japanese assets, which would be a big move in terms of flows. So there's lots of things that we think could catalyse the yen stronger here, but a lot is relying on the story in the US and the US exceptionalism and the strong growth, and the Fed therefore needing to hold rates higher for longer.
Eva, thanks so much for your time this morning. I really appreciate you coming in to chat to us. It's really great to be able to showcase the investment team and the skills that we have within the wider group. Look forward to having you back in Cape Town very soon.
Thank you for having me.
And for clients looking to access Eva and her team's skill set, remember that you gain exposure to our global fixed income team by any of our multi-asset class funds with foreign exposure, as well as our global bond fund offering on our unit trust platform.